Hello, this is Jonah Friedman. Please enjoy these 10 creative ways to finance your next real estate deal that I presented at a real estate meetup. I used to be a special ed teacher, and then I got into being a real estate investor, and I'm also a real estate agent. What I'm going to talk about today is creative financing, because I know for a fact that I wouldn't be where I am now if I only went the traditional way. I had to use lots of different tools to get where I am now. I have to say, I do like bank loans. Like, this isn't something like, oh, don't use bank loans. If you can use bank loans, you can get yourself more bankable, get your credit scores up, whatever it takes. I highly recommend, because banks are amazing. They give you the best rates. And another thing with banks is, most people think like a bank's going to tell you something and this is what it is. It's actually negotiable. I've negotiated rates, terms with many banks, many of these local banks. I've negotiated appraisals that came in. Everything is negotiable. Just because a bank tells you they won't do it or this is the way it is, it doesn't necessarily mean it is. So remember that. That's really important. I'm going to tell you the 10 creative financing ways that I have used other than bank loans. And I'm going to kind of explain them all, and then I'm going to see if anyone has a question or two, and then I'm going to tell a story how I used all of them in my own life. So like if it doesn't make sense, you're also going to hear a story, so which will solidify it all. The first couple of these creative financing techniques actually use banks. So the first one that I like to use, and this really works if you already have some assets, is a cash out refinance. A lot of people think you need to get just a brand new bank loan, but a cash out refinance is just if you have a property, look to see with the banks if you can refinance, if you can pull extra money out of it. Because when you have, a lot of people like to talk about their equity, like how wealthy they are. But when you have equity in a property, it doesn't mean anything. It's just sitting there. It isn't making you money. So my whole philosophy and how I've built, my portfolio is all about the philosophy of money. I want to keep my money moving as fast as I can. So when I have equity in a property that's just sitting there, I'm going to go look and see if I can pull some other cash out of it. So cash out refinance is the first technique that I think is really useful. The second one is also used in a bank, is a home equity line of credit. There's different terms they do if it's a business line of credit. But this is kind of like a credit card. A lot of people who own properties have probably used these. It's like a credit card, but it's based on your house. So then you can constantly pull the money and then pay it back, pull the money, pay it back. I've used home equity lines of credit all the time. I always have a couple evolving, keeping open, because these are really great ways to have instant access to cash. So again, it's similar to a cash out refinance. If you own a property, you're gonna look at the home equity line of credit. And you can do that for rental properties or your personal property. It's just different terms and stuff. If your personal property, sometimes they'll go to a higher loan to value, the LTV. And I guess probably in the future, Kelly may have a banker come and they can get into more details how you qualify for loans and how to actually qualify for all these things. But I wanted to do just a quick overview of these terms. The third creative financing technique that I've used is also using a bank. It's a personal loan. A lot of banks, just based on you, who you are, maybe you have another business, maybe you've had a strong relationship with a bank, will loan you money on you. It's not attached to a property, it's not attached to anything, they'll just give you a personal loan. And this is definitely a useful technique to consider sometimes. So that's 3 of them. The fourth one is credit cards. I think credit cards are actually pretty freaking amazing, as long as you have control with them. So credit cards, you're going to spend the money anyway, right? So especially if you're doing a rehab on a property, you might as well use a credit card. Because when you use a credit card, you get all these points. Like my family, we like to travel, like right before COVID hit, we were in Thailand for 2 months, and I didn't pay for any of my flights because I just collect so many points running my business, and I'm able to fly my family all over the place. So credit cards are great. And I know you're probably thinking like, okay, that sounds good, but how does that help me buy a property? Well, a credit card will help you with the repairs, but also credit cards will sometimes give you a loan, just like the personal loan a bank will give. I've actually borrowed from American Express at 7% in the past. So way lower than 18 or 20% they'll charge. They'll give you like a 2-year loan. So you can look for that. Like a lot of credit cards will do these kinds of things depending on the rates at different times. Number 5 is partnerships.
Okay, there we go. That's important.
Thanks. I skipped it. So number 5 is partnerships. This is exactly what it sounds like. It's just having a partner, like in any business or anything. You have someone you go in on the deal with. And there's a lot of ways you could structure this. Maybe somebody brings the money. Maybe somebody, brings the deal. Maybe you're 50-50 on the money. Maybe, someone has all the hustle and all the experience. Whatever you have, partnerships are a really great tool, and I've used partnerships so many times. What I would say, though, is when you use partnerships, the most important thing is to be really clear at the beginning in expectations. Like what each person's role is, how you divide the responsibilities, and I would highly recommend if you have a partnership, you start an LLC or something to make it very official. So now we can go to number 6. And again, I'm just kind of moving through these quick, and I'm going to tell a little story about how I've actually used pretty much all of these techniques in 1 year. So, all right, so number 6 is private money. And I love this one. Everybody knows somebody who has some money, right? Maybe, I can't think doctors, lawyers, business owners. There's a lot of people out there, especially with the way the money's been flowing, there's a lot of people who have a lot of money and they don't know what to do with it. So I have used this a lot. Think about the people who have money, and you go to them and you ask them to lend you the money. Instead of a bank, they're just lending you the money. And there's a lot of ways you can structure this. If they trust you, guarantee that you'll pay the money to them. Or if you buy a property, you can put a lien on it and do it the same as like a bank. If you didn't pay them, they can take the property back. When you go to ask someone about borrowing money and private money, you approach them like, I really need this money to get this deal done. Oh my gosh, I'm in a hard spot. Do you think they're going to lend you the money? No. No, probably not. But if you approach them and you're like, hey, you've always talked to me about real estate, you're curious about this stuff, you know I do it, you know I'm good at this, how would you feel to make 8%? People are going to be like, yeah, it's that simple. And it doesn't have to be 8%. I'm making up that number. Maybe it's 4, maybe it's 5, maybe it's 10. It's whatever you work out, and you can work out the terms too. And that is a really great way to get access to more capital. 7 is owner financing or seller financing. When you go to buy a property, it's asking the seller to be the bank. So instead of you buying it and they get all their cash in their pocket, they're going to loan you the money. There's a lot of reasons sellers would want to do this. One reason might be that you get all the cash at that time, then they're going to have to pay capital gains tax, and it's going to cost them a lot. If they seller finance to you and you pay a monthly payments just like you would a bank, they can structure their business how better so that they can pay less taxes. This can be a very win-win. Also, a lot of people who are selling real estate, there's a lot of reasons. Maybe they've owned real estate for a long time and they don't actually need any money, they're just tired of it, and they like the idea of just getting monthly payments. So owner financing, seller financing is huge. And another really cool thing about that is how you qualify for a seller finance or owner financing loan is just between you and the seller. There's no rules like the bank's going to say you need this credit score or you need this down payment or anything. I mean, I've negotiated on seller financing deals where I put 0% down. Anything is possible. It's just, does it work for the seller and it doesn't work for you? And plus, once you do seller financing, owner financing, you get to know people, you learn. And I've had people who I bought a property from, they seller finance, they love that I'm paying them every month, and then they loan me money on another property later because now they trust me. So seller financing is huge. Number 8, this one is a little interesting. It's kind of like seller financing 2.0. It's when you assume a mortgage. And this is a really interesting one that a lot of people don't know about. So let's say you're going to buy a property. Instead of you getting the seller to become the mortgage, all you're doing is you're taking over their mortgage. Because most sellers have a mortgage. They're making payments. You just go in and you say, all right, I'm going to take this property and I'm going to start making your payments. There's a couple caveats with this. A lot of banks, at least now, bank loans don't allow this. There are some that do, but a lot of bank loans don't allow this. But if you find someone who has a private note, an owner finance debt, these, a lot of them do allow it. And even if they don't allow it, a lot of times you can negotiate it because the person who did the owner financing originally probably doesn't want to get paid. There's a reason they structured the deal this way. And if they trust you, they're going to be happy that you take over the payments to them. So it's pretty much, you're just going in, you buy a property, and you take over their mortgage payments. So that's a great way you can get into a deal with really no money down. It's the perfect deal. Number 9 is lease options. Most of us, or at least we want to be, are landlords, where you rent a property out to a tenant, and they lease it from you for a set amount of money, a set amount of terms. A lease option is the exact same. You go to an owner, and you negotiate terms, and you rent the property from them. You want to make sure that when you rent it from them, you've agreed that you can re-rent it. Like, you want to structure your deal in a way that works for you. So essentially, you can rent it from someone, and then re-rent it to the tenants. And also attached to this, because you want to buy it ideally, because just leasing an option is great, you get that cash flow, but you want to end up with the property. So you want to do a lease option, and you want to have the option to purchase as well as part of the contract. You would have it as 2 separate contracts, so they've agreed that you're going to lease it from them, and you've also agreed on a sales price somewhere down the line. Like sometime in the next 3 years, we've agreed this property is going to be sold for $250,000. Both people sign up on this. So lease options are another great tool. And the last one that I'm going to touch on today is hard money loans. I don't like using this one as much, but I think it's also an amazing tool for the right situation. So I know everybody gets those phone calls like, hey, I can lend you $25K tomorrow. I don't know, anybody else get these robocalls? I get them all the time. It's in your bank account. They're kind of like hard money loans, but I think those were probably scams. But there are people who actually do this. They lend money to either a group of people or some like corporation or an individual, and they loan money out. I get letters in the mail, and you can research these companies, and they're legitimate companies. They're kind of like banks, but they can close quickly. They don't care about your credit score. They look just at the deal. They're going to charge you a lot, 10, 12%, whatever, way more than banks, whatever. But again, a really great way to find out about hard money lenders, I mentioned earlier, I think Kelly mentioned, is Bigger Pockets, which is a site I like. If you're interested in real estate, write down Bigger Pockets. They have so much information on there. And on there, you can go down, they have a list of hard money lenders that have all been like accredited, you can trust them. So there's a whole bunch of people who do this. So you can find hard money lenders. You think like, why would I pay 10 or 12% for money when you can get bank loans for 3% or whatever? Well, because you can't get a bank loan on this deal. And honestly, like, who cares how much money you pay for the money as long as it makes you more money, right? So if it doesn't matter. So many people get so attached on like, I would never pay 12%, I would give them 100% if it's gonna make me 120.
I have a question about owner financing, 2 questions. So for that, usually how long is the term of your agreement that you're paying for the house? Is it like a year, 20 years, 30 years?
So this is a great question. Again, with the beauty of owner finance or seller financing, it's completely up to you and the seller. It's totally negotiable. I would recommend when you go, like if you see someone, you want to consider asking them if they will seller finance, just ask them some questions like, what do you want? How long would you be open for a loan? Do you want the money now? Just find out what they need, like just human questions. And some people don't want to get paid for 20 years. Instead of 20 years. Some people are like, I need the money next year, then maybe you do a 1-year loan with them, and you call it a balloon, which means the payment is due next year. I don't think there is an exact way. And there's another quick question, anyone?
What did you use for your first investment property?
My very first property I bought, I actually used a bank loan, and I cashed out some savings bonds, and I borrowed money from my aunt. So yeah, that's how I bought my first property. And my second property, I borrowed money from a friend of mine who's an engineer who lives in California and makes a lot of money. Those are my first two.
Cool.
I'm just curious, how have you gone about getting personal loans this way?
Well, I just call them. Myra Savings has given me personal loans. There's only one that I've gotten, I've done it twice with them. And I just asked them if they would give me a personal loan. And they said they would give me X amount, or if we could tie it to some asset, they would give me this amount. And it was great rates, and it was a 5-year loan. And I know a lot of banks will do that, and especially someone like, if you have a lot of business experience or you've done a lot with the banks, I would just ask them. I don't know. I'm going to tell you how I use almost every one of these techniques in 1 year to buy 7 properties, all in 1 year. This was a good jump for me. And these aren't like $50,000 properties. These These are like lower college town, you know, 500,000 plus properties. So if I had to come up with all the capital, it wasn't really possible in my life. And I'm not telling you this story because I just want to like talk about how cool it is, but rather I think it's such a good way that everybody can understand how you can actually use this to see how I've used it. Tony Robbins says, most people overestimate what they can do in a year and drastically underestimate what they can do in a decade. So a few years ago, I had this opportunity to buy 7 properties 1 year. It wasn't like the year started, I was like, yay, 7 properties. Didn't play out quite like that. So the first one, as someone I know, a local landlord who owns a bunch of properties in town, and I actually called him. It's actually funny now that I think about it. I called him to invite him to be in a mastermind group that I had started. And I totally forgot that's how this all happened. And I asked him to be in the mastermind, and he said yes, and he came to the first one. And then we were leaving, he said, hey, I'm thinking of selling some of my properties. Are you interested? And needless to say, we negotiated and talked for whatever, 6 months, a year, I don't know. It takes a long time to negotiate these things with some people, especially someone you know. But we came to an agreement where I was going to buy 4 properties from him. So I didn't have enough money to buy all 4, so I had to figure out how to be creative, like he said. So this is how I bought the first one. The first one, I asked him, I said, hey, if I can bring you all the cash for the other 3, all the money, you know, so you don't have to worry. Will you seller finance me the 4th one with 0% down? Because you're getting 3 completely, you know, all the cash cashed out. And he said, yes, I'll do it. So for the first one, I was able to get into it with no money down. But obviously I had to come up with the other 3 properties. So that's how I used the first technique with him, seller financing. And I got a 0% down. He didn't give me a 0% loan. It was reasonable. I think I paid 5%. And it was on a 30-year, 10-year balloon, I think, if I remember the terms correctly. All right, so I've got this first one locked in. How am I going to come up with money for the other 3? So for the second one, what I did is I reached out to my engineer friend. Same guy lent me money on the second deal. I was like, hey, I got this great deal. I think it's going to be great. I don't have the money. You've been talking to me about getting real estate. How about you put the money down? We'll go partners. And we worked out a structure where I would pay him back over a couple of years of my shares of the profits. I would manage it, which would come out of my share of the profits. And he agreed. We created an LLC. We got applied for the bank. We got approved at the bank. So I had a partner lined up for the second one, which was great. The third one, now I remember. That's why I need my notes. The third one, I used private money. That's right. So I had the partnership, which is kind of like private money, but he actually had equity. He had in the deal. So for the third one, I had a friend that he had been lending me money. I'd been flipping a few houses here and there. I don't flip too many, but I flip a couple. So he was like my lender on when I would flip houses. And I just closed on flipping one, and I said, hey, how would you feel if we just push your payment back for a year or so? And he trusted me already, so I was lucky that he gave me a private note just with me guaranteeing it. It wasn't attached to the property. Because a lot of banks are gonna like you to put a private note in second position. That's gonna be tough. Sometimes you can, as long as you stay under a certain amount of value, but a lot of times they won't like that. So my friend, he agreed. He said, oh yeah, another year. So I was able to use his money, private money. I was paying him a little bit more than owner finance. I think I was paying him 8%, but you know, it got me into the deal, right? And for the fourth one, this is where I used my home equity line of credit. I was lucky that I had this line of credit. I used that, and I also had a little money saved. Like I mentioned, I just flipped the deal with this guy, and I had some cash, so I did it. So there you go. I bought 4. Perfect, right? Well, no, it didn't quite work out like that. So it turns out when you have a partner, and he's really excited, and you sign an LLC, and you're going to close in 2 weeks, and everything's great, and then all of a sudden you don't hear from him for 2 days when you need him to sign the paperwork with the bank, there might be an issue. Finally, I get in touch with him, and another word of advice, if you get a partner, make sure that he's cleared with his spouse. He never asked his spouse. Never brought it up to her. And I'm really close with this guy, and I know his wife too. She's super nice, we're friends, but I didn't think I needed to talk to her as well. I thought the deal was on lockdown. And he had never talked to her, I guess. So he called me and he was like, I can't do it. She says, no. I'm like, we're closing in 2 weeks. Like, if this deal falls apart, like, it's dominoes. I lose all 4 of them. Like, I need to, like, figure out how to close this. And he's like, sorry, man, I can't do it. I mean, He was the freaking best man at my wedding, but whatever. So now I needed to come up with the money. All right, what am I gonna do? So I called every bank I was involved with. I was worked with Tompkins Trust and CSU, Alternatives, and Elmira Savings at this point, and said, hey, who can give me some money? Like, I want a personal loan. Anybody give me a personal loan? And Elmira said they would give me a personal loan. I also was lucky to have a car that we didn't owe anything on, so I took a loan on that as well. And I was able to get another bank to give me the loan on the car. Then I took the personal loan, and then I went to my credit card, again, my other technique. And luckily at this point, American Express was doing some special, and they would lend money out at 7% interest for 2 years. So I borrowed as much as American Express would give me, and I borrowed everything I possibly could, and I was like tapped out. But I got the 4 done, and I closed on them, and that was great. I was feeling like, this is awesome. And then pretty much like 2 weeks later, another opportunity came out, and I didn't have any money, so I was like, okay, we're gonna have to figure this one out. Because I don't wanna let it go. Which is great to be part of a group like this. I wanna step back. The first 4 I brought was from a local landlord that I've met in a group like this. The next one I'm gonna talk about, also another landlord, the other ones too. So relationships like this are huge. Maybe someone has a property here and wants to sell to someone else or whatever. So I think it's really good to network at these things. So the next person, he came up to me and said he wanted to sell the property. And I wanted to buy this one because it was right near another property I already owned. And the problem was, it needed some work. And I knew one side was vacant, and I knew it wouldn't appraise for what I needed at the bank, and I had no money for a down payment. And I didn't think a bank would give me a loan because I just got the 3 other bank loans, which was already pushing it. So I asked him, I said, hey, you know, we know each other, can we do an option, a lease option? Can I lease it from you, and then let me rent it to whoever I want, and let's agree on a future date, 2 years from now, that by that some point to now, I'll buy it at a set price. And we worked out all these terms, and we agreed to do it. And the way I approached him about it, he didn't want to manage it. He didn't owe any money on it. He didn't want to sell or finance it though, for whatever reason. Everybody's got different things. But he liked this lease option idea because I was able to draft it in a way that he still made a good chunk of money every single month. And he didn't have to do anything, and he knew I was going to come and buy the property. And if for some reason I bail on buying the property, he gets to keep it, and he just made that money for those 2 years. So we came to terms and we agreed to that. So that's how I used the lease option. I had to do some renovations in this property to get the bank loan. So I would say when you do a lease option, if you need to do some work on the property, make sure you have a relationship with the person. I mean, make sure your contract is solid. That was the one part of this deal that made me a little nervous, that I was sinking extra money in if he bailed. But, you know, I kept going over and seeing him, and I'd carry my son. It was like 1 at a time. I was like, he's not going to screw him over. So, cute kids can have it. But I felt like I could trust him, and so I renovated the property. And about, I think it was a 1.5 years later, so I renovated, I had brought it up to where I needed it to, so I could get it to appraise where I wanted it for our agreed price and everything, and I could get a bank loan. And so that's how I used another one of these techniques, lease option. And I also used the cash out refinance in this one because I had waited 1.5 years. I had another property I had owned for a while that I was able to cash out refinance and use that money to buy this property. So I think I've gone through like 6 or 7 of the techniques, and this is like 6, 7 months into 1 year. That was about 4 years ago. And then another opportunity came. Someone in our office, Kyle Steele, I wish he was here, brought up a property to me. And I had helped him out with another deal and stuff. And he was like, hey, I can tackle this. Are you interested in these 2 properties? And it was right where I like properties. And I was like, I say yes. I like to say yes to things like this. Even though I don't know how I'm going to do it, I like to say yes. So I was like, yeah, I want to do it. So I negotiated with the owners of these 2 properties. It was 2 more. So this will bring it up to 7. Also in Lower College Town, you know, pretty expensive houses. And what's crazy, this has been an up market, right? Everyone's watched how property values have gone up. These people, sadly, had kind of run their properties to the ground. The price that we negotiated that I could buy it 5 years after they bought it, and these are in great locations, was quite a bit less than they had actually paid for them. Because they were like, lots of issues. I don't know if anybody remembers, there are a couple articles came out, it was like in the Cornell Sun and everything about bad landlords that were making their tenants heat their houses with their stoves.
Oh my God.
Yeah, so I read that article, and 3 months later I bought the property. But I learned a lesson there. I should have called him right away. So I had to figure out how to buy these. So we agreed on a price, but here was still the issue. In order to make this work, I had to buy them, come up with the money. Well, when they had bought the property, they had bought it from a previous landlord that a lot of us may know, and he sold all his properties with notes, seller finance, all of his with notes. And all of his notes that he sold it with, because he didn't want the money, this was his retirement. He did 20-year mortgages on everything. He sold his whole portfolio. And in his mortgage note, he said that if a new buyer comes along, as long as I approve of them and they pass all my tests, whatever, he made me mail them stacks of stuff, but they can take over the mortgage, like assume the mortgage. There was also another clause in this mortgage. There was a 10% prepayment penalty, which still exists now. So the owners on these two properties, they wanted to sell. No one was going to pay what they needed. They wanted out, and if they sold, they were going to have to get hit with a 10% prepayment penalty on these two mortgages, which was something like $800,000. So not 800,000 mortgages, so that's $80,000 extra. They would have had to pay what they exited. So when I talked to them, we were able to get to the agreement that we could buy it at a price, and that I would take over the mortgages. But I had to convince the previous owner who was doing the seller financing, and I reached out to him, and he said no, as people do. And then I called him the next day, and he said no. And I called him the next day, and he said, send me, your credit score, etc. And yes, so he agreed. So I assumed the mortgage, and I took it over. So I got these two properties, and I bought them at a price that these people just wanted out. I came up with hardly any money down. It was like $20,000 between the two of them because I just took over the existing mortgages. I need to come up with money later to fix them and bring them up, but they just wanted out. And they didn't want to pay $80,000 because the profit margin wasn't there. They would have had to come up with money out of their pocket. So I took them over, and that's how you can assume a mortgage. And what's kind of cool going with this one is I still have those mortgages because there's a 10% pre-penalty, which now I'm screwed with, but it is what it is. But that owner, and this is why it's really good to talk to sellers, he did not want to get cashed out. He doesn't want to get cashed out ever. So I went to him at one point, I was like, can we lower the rate? Can you get rid of the 10%? I want to refinance, I have a lot of equity, blah, blah, blah. And he said, no, I'm not getting cashed out. So then I was like, hey, how about if we move it to a different property, combine the two? And he said, fine. So I ended up moving that mortgage to a different property, and it's on a totally different property that wasn't involved in this deal. But he's happy because he's getting his monthly payments, and then I was able to cash out and pull some more money to continue this whole cycle, accelerate the money. So that's how I used 9 out of the techniques. Well, actually only 8 because my partner bailed. But I have partners right now, and I have had partners in the past, and I think partners are great as long as you have clear expectations and stuff. Does anyone have any questions? Yes?
It's not super directly related, but it sounds like you do a lot of business with friends, and I feel super apprehensive about doing any business with friends or family. What's your approach on that? Because I'm really worried that if something goes south, we won't be friends anymore. So is that just a risk you take? Hey, if this goes south, I know this person isn't going to be my friend anymore. Is that something you think about?
As far as taking that risk, you take risks all the time. That's all the more motivation to not screw it up. I don't know. Yeah, you take that risk. Yes?
Leverage is not a bad word. I love it.
I love leverage too. That's such a good point, Brian. Yes, that is the theme of my presentation. I would not be here where I am in my career, the success I've had, without a lot of leverage. And it can be scary, I understand, but if you're born with a ton of money, you gotta use leverage in this game.
What would you say to people who just have fear of don't want to invest in real estate because they're just scared or nervous? And you found the need, or many of us found the need to take that jump, and we find it is not a risk because we're like, well, it's more risky depending on your job you can get fired at. But
yeah, I'd start with not everyone's meant to invest in real estate probably. Some people it is too risky for them and they can't handle it. So some people probably shouldn't buy real estate. It's probably some other thing for them. But for the people who you feel have this, tell your story. Any of you who have a little success, I just tell people what I've done. I'm hey, I'm going to Bali, and Yeah, I'm with my kids at home having lunch, and I do all this because of real estate. I'm no different than you. I had a regular job. I was a teacher making $40,000 a year, and then I decided I wanted to do something different. And also, as far as the risk, yes, it's risky. But again, like Matt, you were touching on this, I would argue it's inherently way more risky to not take chances. Like, 'cause you only have one option. At least when you take chances, you have these options. And I'm not saying take crazy risks. Like, even though it might sound like I'm taking risk and use leverage, I'm very careful about which deals I go for. Like, I'm very careful. Like, the reason I was willing to leverage these 7 properties is they're in great locations. I know the market, and I know these properties are gonna do well once I get them under control. So like, I trust myself, I trust the property. So I didn't feel like I was taking any risk.
I have a question.
Sure.
When you're getting money from family or friends, do you care where they get the money from? Not illegal stuff, but just like,
I mean,
are they taking out a HELOC when they shouldn't?
no, as long as it doesn't put them in a bad situation, right? So like if they're
Not illegal
leveraging
ways.
up, you don't want to be borrowing money from someone and your deal goes south and you only borrow money for a year and they need that money in a year.
Yeah.
You want this person to be able to extend it for a year or two if a worse thing happened. So I would only borrow money from people who can afford to lend you money. Now, having a partner is a little bit of a different thing. I would partner with people who don't have that money because they have the sweat equity or whatever, because they're part of the deal. Like they're doing the work. Prices are elevated. I would argue they're not as elevated as people actually believe for a number of various reasons, probably namely the cost of money is so cheap, which means everybody can pay way more. So like a lot of times people like to argue that properties are so expensive. They're still in their mindset of when like mortgages were 18%. Like this is a little bit off topic, but like I talked to a lot of people who got mortgages in the 80s or whatever, and their whole thing is pay your mortgage off, pay your mortgage off. And it made sense when your mortgage was 18%, and some people still have that. When your mortgage is at 3%, it doesn't make sense. So the first part of that is I don't know if they are necessarily as expensive all the time. Second part is there are deals to have out there, and one great way is to talk to a great agent. You know, there's a bunch of them here, and they'll help you with that. And another, you know, is networking. And look for the diamond in the rough. Look for the deal that you're probably going to pay, like the way the market is, you're going to pay more than you think you should pay. Actually, everything, I always pay more than I think I should, every property I've ever bought. But you got to see that there's some value to be added to it. Like, you know, like I buy everything based on cash flow, but it's a little confusing when I say cash flow because it's not cash flow always on like the day you buy it. It's like the cash flow that I know I can achieve within 6 months or whatever. Because if you have to be achieving that cash flow on day one, you can't buy properties that need work. You know what I mean? So I like to take on properties that have issues. Because if there's a problem and you can solve it, there's money to be made. Yes, Brian?
To answer your question, today people look at properties and they think that the sales price is high. Like Jonah said, the cost of getting that money is really low. So when I bought most of my properties, it was around 99, 2000, 2001. I was paying 9, 9.5, 10% interest on all of them. So as he said earlier, I didn't care what interest he pays as long as it's cash flows. So I looked at the properties, they made me the money I wanted, and I bought them. And then what was great for me, nobody else wanted to buy them. Everybody thought the interest rate was too high. Or not nobody, but a few people, a lot of people were not buying. But then over the years, every time the interest rate dropped a couple of points, I refinanced, took a whole bunch of money out, and didn't pay income tax on it.
Yeah, as Brian mentioned there, that's another amazing thing about cash out refinancing and HELOCs. You're harvesting once you get some properties, you harvest all this money, you don't pay any taxes on it. It's all legal and you have constant flow of money. I mean, wealthy people borrow money all the time. Like I read this thing about like the richest people, Beyonce and stuff, they borrow 100% loans on their houses because they realize the value of it. They'd rather borrow the money. So, yeah.
Thanks, Jonah.
Well, thank you, everybody.